From the Toronto Star, I'm Adrian Chung, and this matters. Canada's economy had its worst year on record in 2020, shrinking by more than 5%. But the numbers show Canadians are sitting on tens of billions in savings. The Bank of Canada says household savings reached $180 billion. Savings rates skyrocketed. With nowhere to go and little to do, many Canadians are simply spending less than they would in a normal year. If you've been fortunate enough to save your money, what's the best way to use it right now? What investments should you be looking at? Is a rainy day fund a good call? And especially for millennials dealing with debt and gig work, what can we learn from this moment? On This Matters, we're talking to personal finance expert Preet Banerjee. Preet is the founder of Money Gaps, a financial planning company, and the host of the Mostly Money podcast. He'll walk us through some tips on how to deal with your checking and savings accounts to prep you for post-pandemic living. Preet, thanks for making the time to join the podcast.
My pleasure, Adrian.
Every month since the pandemic began, I look at my credit card statements and I can see how much less I'm spending now compared to life pre-pandemic. The data from the Bank of Canada shows it really isn't just me. A great number of Canadians are spending less now and saving more these days. In what ways do you think our spending habits have changed in the past year?
I think there's two big ones that can explain what we're seeing in the data. The first one is with the lockdowns, we just haven't been able to travel. And for a lot of people, one trip is a few $1,000s. And if you have multiple people in your household going on a vacation, that's many thousands of dollars that you weren't allowed to be able to spend. And so for a lot of people, they're sitting on that much extra cash. But then the second big factor is also when this all started and we started seeing these lockdowns and these incredible numbers across the globe, a lot of people got cautious and they said, well, just in case, let's pull back on the reins a little bit to rein in our spending in case this really hits hard economically. And those are the two big factors that I've seen is that one, we've just been prevented from spending on a lot of the things that drain our pocketbooks. And two, a lot of people took a cautious approach.
And of course, millions of Canadians and people around the world too, many people unfortunately lost their jobs. And so really people had to tighten their belts in ways that perhaps in the past few years they haven't had to think about quite as much.
Yeah, and it's definitely a tale of two economies, as you'll hear a lot of people say, because yes, there have been a lot of people who have, lost their jobs, but this has been concentrated on the lower income side of the spectrum. It has been concentrated on people who are, frontline, working in retail, the most hard hit industries because of the lockdown restrictions. And at the same time, there's been a lot of government support. And in some cases, the replacement ratio was higher than the income for some of these lower income workers. And that has led to some extra savings for people who actually lost their jobs. And so when I say, it's a tale of two economies, you also have on the other side of the spectrum, a number of people who didn't lose their jobs, but were working in more knowledge economy type professions. And so they were able to work from home because they could. And so maybe they didn't lose their income, but they lost their ability to spend money as freely as they did before. So they've been sitting on a lot more money. It's been very much a dichotomous situation because those who have been hit hard and have lost their jobs, some of them have really been hit hard. Some of them are actually sitting on as much or if not more financial resources than they had before because of a lot of government support.
The Bank of Canada says household savings in 2020 has risen to $180 billion, a massive number, clearly. Can you put that kind of number into context? Does that prove people are holding tight to their money, waiting for the day they can spend on goods and services again?
I don't know if it's so much that people are having that much foresight to say, oh, let's really pull back on those reins. I think a lot of it is just because a lot of people have been prevented from spending money like they have in the past, for sure. But if you take a look at that number, it was the Bank of Canada just a week or two ago. They had made some comments about the amount of savings. And on a per person basis, the average Canadian household savings rose $5,800. I think it was per person, actually. So a significant amount. And if we take a look at some of the things that we're seeing, there's a lot of things that, make people scratch their heads like, okay, this is one of the greatest disasters that we'll likely, hopefully, see in our lifetime. And at the same time, house prices continue to go up. So how do you reconcile these two things? And part of it is, again, the people who have not lost their jobs tended to make more money. They were probably the ones who were more likely to be in the position to afford housing, and they're sitting on a little bit more savings. So some of them are saying, okay, well, let's make hay while the sun is shining and use this extra savings that we have to maybe bid on some of these houses. And the people who have been more negatively effective probably weren't as likely to be in a house buying position in the first place. And so when you look at the overall housing market, it seems to defy everything that people have been talking about, how bad this pandemic has been overall for the economy and people. The housing market tells a different story.
There's little signposts along the way that show that, again, in many ways, we have been talking about how this pandemic is disproportionate. It hits people disproportionately, especially depending on your income, on wealth. And we're seeing that in little indicators along the way, too.
Yeah. And, another thing that we've seen is a huge increase in first-time investors. There have been a lot of surveys released by brokerages and companies that provide investment platforms saying their wait times are hours on end because of the incredible number of signups. We've seen, things happening with GameStop, the Wall Street Bets forum, and a lot of activity around investing. And part of that is because there are a lot of people who don't really have anything to do because they're locked down and they're sitting on some extra savings. And so some betting was not available. You couldn't go physically to a casino, so you can bet in the stock markets. And we've seen a lot of activity with people investing in a very speculative manner because they've got time and money on their hands that they didn't have before. And so there's so many fascinating aspects to what's been happening, with our savings rate and our spending and how our preferences have shifted temporarily. And the question is, what's going to happen when all of this unwinds? Are people going to spend with vengeance? We've heard the terms such as revenge spending being a thing. Are we going to learn some lessons and put those into practice going forward? Or are we going to snap back more quickly than we might expect?
People come to you for advice in terms of their own personal financial planning. For Canadians who can afford to save right now, is this a chance to do something different that perhaps they haven't had before? Like, what kind of advice would you give them on how they can make use of their money?
Yeah, it's a great question. I think it is something that people do consider. And I think some of the conventional pieces of wisdom in the personal finance space has been about emergency funds and how much should be allocated into an emergency fund. And if anything, for people who have lost their jobs and didn't have access to government support, I think people are starting to rethink, just how much should go into an emergency fund. Rule of thumb used to be, 3 to 6 months. That probably is still true for most people. However, if you're in a job or an industry where it might take you a year to find a replacement similar job, and that is definitely the case if you have spent more time in school and you're in a more specialized field, it can take longer to actually find your next job that pays a similar amount. Whereas if you're in, more of a retail position, something on the lower end of the income spectrum, you can actually find a job a little bit more quicker. And so the 3 to 6 months still tends to make sense as a minimum. But there's some people who have realized, I maybe need to think about having 12 months of some kind of resources. That could be a combination of a dedicated emergency fund, as well as making sure that you are investing so that becomes a fallback if things really get bad. So the emergency fund savings is certainly something that is being rethought. Some people think that a line of credit can serve as an emergency fund. And what tends to happen is, if you have the economy going into a recession and the credit cycle tightening, which hasn't happened for a while, but if the credit cycles tighten, then people who provide those lines of credit are going to say, listen, we're going to reduce the amount of credit we make available, or we're going to call in those lines of credit in some of the worst case scenarios. So you can't rely on a line of credit as an emergency fund. You really do need to have a savings account or some type of dedicated emergency fund account. And beyond that, I think when it comes to the reopening of economies and a reopening of our spending, this is an opportunity to really think about what are some of the expenses that we gave up that maybe we really don't need going forward, because we are now in a subscription-based economy. So many things are priced per month, gym memberships, media subscriptions, software subscriptions, and we have so many of these little software subscriptions, and all this stuff adds up. And so when you think about, all right, maybe I feel a little bit more confident, the economy is opening up, how do you reintroduce those old expenses? And do you reintroduce them all? Because this could be a bit of a reset with your finances to free up some of that room. Because one of the other things people have realized is, wow, it's pretty cool having some money set aside, actually having some savings. And so, you can still do that too by thinking about how you reintroduce some of those expenses you gave up during the pandemic.
We'll be right back. What about paying down debts? Have you heard of people, especially millennials, many who have student loans? Have you heard of people using some of that money to pay down some debts that perhaps they've put off for a few years?
Yeah, absolutely. There's the opportunity to reduce debts, to invest. You have a whole bunch of opportunities when you have extra savings on the side. And generally speaking, the conventional wisdom holds up, and that is if you have very high interest sources of debt, you want to aggressively tackle those. Certainly, if you're carrying balances on credit cards, that's a no-brainer because you're paying double-digit interest rates. But what has changed also recently is, as long as you're being responsible with the total amount of debt, if you have a mortgage, your interest rate is very, very low. And so the temptation to pay down any type of debt aggressively is reduced for those who have very low interest rate sources of debt. And so that is one thing that we've seen change lately because interest rates have been so incredibly low as a means to stimulate spending and try to sort of deal with the economic fallout of the pandemic. For some people who are thinking about, all right, I could invest this money or could pay down debt, one of those factors you have to consider is what's the interest rate you're paying on that debt. If it's very high interest, yes, that is still going to be the preference. But if it's a very low interest, you've got a responsible amount of debt, maybe you want to invest that instead. And the second factor considers your risk tolerance. So the more conservative you are, the more you want to pay off debt for sure.
Right, of course. And with those investments, as you mentioned, a lot of people are getting into cryptocurrency, but it depends on your tolerance for risk, whether or not you want to look for something a bit more long-term in those investments or perhaps something that's a bit more of a short-term game.
Yeah, I'm seeing a lot more people being speculative with cryptocurrencies than they are looking at it as, a portfolio tool. There are some people who would suggest that, listen, if the conventional wisdom is, 5 to 10% of your portfolio is in a hard asset like gold, maybe you substitute part of that gold allocation with cryptocurrencies if your view is, it's an inflationary protective part of a portfolio. But I see a lot of people who are putting 100% of any excess cash into Bitcoin or Dogecoin or Litecoin only because other people have been making a lot of money in the last year. And so that is the wrong way to invest. That is not investing. That's more speculation and more gambling. And so I see a lot of people dipping their toes into these things because there's a fear of missing out on these gains that people have experienced in the last year, thinking that this will continue without really understanding the risks. The other side of upside volatility is downside volatility. And that is a historic mistake that a lot of people make when it comes to investing their savings.
I'm also thinking about millennials. That's my generational cohort. And there was a report from CIBC back in March that said people aged 24 to 35 are more conscious than ever of their spending habits, that financial security, perhaps for the first time in their lives, they're really thinking about that. And we know, for instance, that lessons and habits learned, let's say, in the Great Depression, it influenced our grandparents and it influenced the way they treated money and emergency funds and stashing away money. What sort of lessons do you think should millennials and young people take from this time?
Well, what they should take is, this sense of having contingency plans in place, because we see how fragile our financial situations can be when things don't go right. And, this generation of millennials has grown up with a lot of hurdles, incredible amounts of student debt, high house prices, job precarity, reducing benefits at work. And so more of the responsibility has been shifted onto their shoulders. And it is very tough. They've also grown up seeing Wall Street get bailed out for bad acting. And there's a bit of angst against that. And this, I think, is part of the reason behind the Wall Street bets phenomenon, why there is this huge and millions of people who felt disenfranchised because, at the beginning, they saw the great financial crisis and it was always Main Street doesn't get taken care of, Wall Street kind of does. They get the bailouts. And so the trust that they had for the financial services is much less. And so I think this has helped crafted sort of the sense that that group, which Wall Street bets, even though it is, a few million people engaged in very speculative investing behavior, that's the name, Wall Street bets, right? That is gambling. It's not just those few million. There is so many more people who feel that way. They feel that, the ability to really get ahead for that generation is so much harder than for other generations. And so I think that also explains why, maybe people are reaching out into cryptocurrencies and GameStop and speculative investments thinking this is the only way that I'm going to be able to get ahead.
GameStop has captivated Wall Street's attention. The stock's rise has been otherworldly, but the obsession isn't just with the rally. It's with who's making money off of it. Legions of individual investors on social platforms like Reddit are going up against fancy, well-funded, professional Wall Street traders, and the little guy is winning. For now.
Overbidding on housing, the only way I can get into housing markets. And so they're willing to overextend themselves. So I think one of the lessons for the generation overall is, you have to still think about your contingency plans because things can still go wrong. There's so much debt that, if you think about your overall income and how much of that is going to servicing just debt, there's not a lot of buffer in your monthly budgets. And so if anything goes wrong, it goes wrong fast. And so building a buffer, having that margin of error in your finances, not only helps you sleep, it's just a better way to manage your finances.
The term that you used there, I think, was a good one of the margin for error is always slimmer, especially for millennials, as you mentioned, for all the reasons, is always slimmer than you think it is.
Absolutely. And again, part of this has been exacerbated by the super low interest rates, which, for the same level of income, if you have a lower interest rate for borrowing, you borrow more money. And that's one of the reasons why house prices have gone up so much, right? Normally, you would think that the prices of things would be tied to people's incomes, right? If you don't have more money, how do you spend it? Well, it's because of lending. And if the price of renting money, that's what borrowing money is, if the price of renting money has gone down, you can borrow more money. And that's what's happened. And unfortunately, that means that, because, your generation doesn't know what an increase in interest rates is. It's always been falling interest rates. And so that has given people more room to borrow more and more and more and more. And a lot of people will find themselves at a point where that's it. There is no more I can spend now. Everything is now spoken for in my monthly income in terms of here's my car payment, here's my student loan payment, here's my payment for my mortgage. And if things change and interest rates actually do start to go up, it's going to be very tough to do anything. You're kind of stuck in that situation for a long period of time. And that's why having that margin of error, having that buffer in your finances is so important.
Fingers crossed, Q4, end of the year, hopefully things will be better in terms of vaccinations, in terms of where we are at in the pandemic. You mentioned it a little bit earlier about revenge spending, this concept. I know I'm asking you to look into the crystal ball a little bit here, but how do you think that shift in spending behavior, what will that look like? Will we see Canadians go back to spending in some ways like we did before? Does consumer confidence, does that take time generally to bounce back? I know we're kind of in uncharted waters here a little bit, but how do you think maybe end of the year into 2022 will people approach things?
Yeah, I think there will be a snapback in spending for a lot of people. Just my own personal experiences, I cannot wait to travel. I'm going to spend a lot of money going and exploring the world again when it is safe to do so. And I think that's one of the things that a lot of people, depending on where you live, there are different restrictions, different lockdowns, different rates of vaccinations in different countries around the world. So that's kind of been the latest unknown variable. But as we get more and more people vaccinated, and it does look like many countries around the world will have the majority of their populations vaccinated by the end of this year. I think that is when you start to see travel really opening up again. I see a huge amount of pent-up demand for people who want to spend money. There are also a lot of people, because they are sitting on extra savings, there's a lot of guilt that they are maybe doing better than a lot of people that they see around them who are suffering, lost their jobs, and what have you. And so they are kind of thinking, all right, well, when patios are open again, when I can go indoor dining, I'm going to spend a lot of money on alcohol at restaurants and having big meals and going out with my friends. And I think a lot of people are just waiting to do that again. And so as we start to see some light at the end of the tunnel with people getting vaccinations, I think we do see a strong snapback in spending, partly because there's a lot of pent-up demand. People want to spend things naturally. And also because there's some people who are sitting on these huge amounts of savings, and it's going to find a way to get spent.
Preet, thank you again for your expertise. It's always great talking to you. Appreciate you making the time.
My pleasure, Adrian. Thanks so much for having me on.
That is Preet Banerjee, personal finance expert and host of the Mostly Money podcast. That's it for today. Thanks for listening. This Matters is hosted and produced by me, Adrian Chung, Saba Aitazaz, and Raju Muthar. Produced and mixed by Sean Pattinen, and our director of programming is JP Fozo. Our show theme music is by So Called, and our episode music is by Mike DeAngelis. We want to hear what stories matter to you. Please send us comments, questions, or ideas to thismatters@thestar.ca. Please consider supporting the journalism the Toronto Star newsroom does at thestar.com. And don't forget to subscribe to This Matters on Apple Podcasts, Spotify, or wherever you listen to your favorite podcasts. Let's talk soon.